And we're going to talk about Europe. The reaction there has been cautious. Investors are still worried about the drama that could be repeated next year. Jack Barton reports from Brussels.
Shares in Europe dipped following news the US government had reopened for business and lifted the debt ceiling. But the deal was still cause for cheer in the EU, where officials hailed it as the victory of responsibility over brinksmanship.
Clearly that is what we have seen, so we very much welcome the agreement that has been reached, which removes a serious large shadow which had come to hang over the global economy and indeed also the nascent recovery here in Europe.
A default by the US would have dealt a serious blow to Europe. Germany may have benefited from a US default, with investors seeking a safer haven. But interest rates on debt repayments would have soared in Europe's troubled periphery, most likely returning the Eurozone to the worst days of its economic crisis. And then there's trade.
The US has become, again, the biggest non-Eurozone trading partner, which means an economic slowdown or maybe even a big recession in the US is clearly something that would have impacted the Eurozone. Let's not forget, this little tiny growth that we have right now is mainly coming from exports.
European economists are mindful that the deal has a very short shelf life.
The mother of all financial crises at least goes to sleep for another 3 to 4 months, and we see next year. But it could mean that we get another risk for Europe back on the front seat, which is the tapering of the Fed. Because in a way, there is only coming bad things from the other side of the Atlantic right now for the Eurozone.
So Europe exhales, but remains vigilant, knowing the US's political and economic roller coaster ride is not over yet. Jack Barton, CCTV, Brussels.